6 months ago, Wall Street had one major concern about Meta. They are spending too much on AI. Billions of dollars were flowing into data centers, AI chips, and infrastructure, while investors kept asking one simple question: where is the return? And fast forward to today, Meta stock has surged more than 20%, and suddenly the same AI spending that investor once criticized is being viewed as one of the company's biggest strengths. What actually changed is the investment thesis, and understanding that shift is the key to understanding where Meta could go next. Welcome to Bhagat Capital. If you are new here, let me inform you. We do deep research on the stock the market has not yet priced right yet. And today, we are not just discussing the Meta's latest AI announcement, we are answering a much bigger question. Has Meta's AI investment finally started making financially sense? Because if the answer is yes, this rally could have stronger fundamental support than many investors realize. For past 2 years, investors viewed Meta's AI strategy as a massive cost. The company kept raising the capex, expanding data centers, and investing heavily in compute infrastructure. The concern was whether Meta could earn an attractive return on one of the largest investment ever made. Today, that question is finally getting a clarity and path towards that answer. Investors are no longer looking at Meta as just an advertising company spending billions on AI. They are beginning to see an AI platform with multiple ways to monetize the same infrastructure. And that's the real reason the stock has re-rated. So let's break down three developments that completely changed Wall Street view. The first proof that Meta's AI strategy is becoming a real business, not just an expensive experiment, arrived just days ago, and surprisingly, it was not the headline most investors were paying attention to. The first catalyst was Meta's launch of Muse Spark 1.1 and the Meta Model API. Why does it matter? Because for the first time, Meta is directly monetizing its frontier AI model instead of using AI only to improve the advertising. Developers can now pay to build applications using Meta's models. And will this become another billion-dollar overnight business? And the answer is probably no. But that's not the point. The point is that investor can now finally see a direct path from AI spending to AI revenue. That's a much stronger investment story than we had just a few months ago. The second reason Wall Street become more optimistic is Meta's emerging AI cloud strategy. Bloomberg reports suggest Meta want to monetize the part of its excess compute infrastructure by serving external customers. And here is the key insight. Meta does not need to become the next AWS or Azure or GCP. If even a small portion of its infrastructure starts generating attractive external revenue, investors will no longer see those data centers as just a cost. They will see them as productive assets. That completely changes the economics of Meta's AI investment. Generating more revenue is only half the equation. The other half is reducing the cost of AI itself. That's where the Iris Meta's custom AI chip comes in. Iris isn't about the replacing Nvidia, it's about running Meta's everyday AI workloads more efficiently. Every improvement in compute efficiency lowers the blended cost of delivering AI across Facebook, Instagram, WhatsApp, and Messenger. Think of it this way: higher revenue from APIs and cloud, lower cost through custom silicon. That's exactly the combination long-term investor wants to see, and that's why the Wall Street view of Meta is changing. But none of these initiative explains Meta's biggest advantage. There is one reason competitor will struggle to replicate this strategy, and it's worth far more than any single AI model. There is one final reason Wall Street is becoming more confident in Meta, and in my view, it's the company's biggest moat. AI models can be copied over time, but the distribution can't. Meta already has more than 3 billion daily active users, millions of advertisers, and some of the world's most valuable consumer platforms. That means every improvement in its AI model can be deployed almost instantly across Facebook, Instagram, WhatsApp, and Messenger. That's a huge advantage over most of the AI startups, which still have to build products, attract users, and figure out how to monetize them. Meta already solved those problems years ago. So, does this mean Meta is suddenly cheap? Not necessarily. The stock has already moved sharply higher because investors are beginning to price in these new opportunities. But for this re rating to continue, Meta now has to execute. AI monetization needs to grow, and the capex has to deliver attractive ROI. And management must prove that these investments create long-term shareholder value. That's exactly what I will be watching over the next few quarters. So here is my takeaway. Meta didn't become a better business overnight. What changed was the paradigm shift in market confidence that its AI investment could generate multiple sources of return. That's why Wall Street has started viewing Meta less as an advertising company spending heavily on AI and more as an AI platform with a powerful distribution advantage. And whether this rally continues now depends on how Mark Zuckerberg will execute on it. If this breakdown helped you to understand the investment thesis behind Meta's rally, hit the like button and subscribe to Bhagat Capital. I cover US stocks, IPOs, and long term investing through the lens of equity research and not only the headlines. Thank you.